Tim Wixon is a debt funding specialist. Do not let that switch you off. If you have raised or you are intending to raise money for your company in the future, this conversation is a must-hear. It's not just about debt, however. He's an industry insider, so he has seen everything across the several $billion of money that he and his team have lent to early-stage businesses. It's about success, growth, perseverance, and is a fascinating, must-listen conversation. Please enjoy. You've been a lawyer, a regulator, and now you're a banker. Which of those was the least popular at dinner parties?
All three have been relatively unpopular, but probably still banker. Desperate to do something and prove that I could fund a tech company. And so we gave $5 million to a $5 million turnover volumes-based platform company that had zero profit to buy another company that had $5 million turnover and zero profit. Flipping that narrative to cash flow first, security second is a really important start point and dynamic. The things we don't do is take ownership or a shareholding stake in a company or board influence or any of those other things. I think it's really worthwhile for founders and teams to come and explore what debt might look like. Use the tagline that we're very happy if you're growing at 10% or 100%. So we don't need that growth at all cost to make the economics work from a debt funding perspective as well. Those that build really great companies and assets with great value have a really long-term view on what they're doing, but also the ability to chunk that down into the right here and right now. And I think the single thing that I've seen the best companies and founders do is
Tim Wixon, welcome to the show.
great to be here.
It's a pleasure to have you. So in your career to date, you've been a lawyer, a regulator, and now you're a banker. Which of those was the least popular at dinner parties?
All three have been relatively unpopular, but probably still banker.
Still banker. Okay. Do you think there's still a bit of a sheen that sits across the industry and you're hoping to kind of improve that sheen in some way?
I've always tried to go with a narrative that I'm not like every other banker, so I'm one of the good ones.
Yes.
And unlike most of the banking network, I try and help and provide funding to tech companies.
Yes.
And that usually piques a bit more interest and enthusiasm than just banker.
As it did with me, and we'll get in and unpack the conversation for those wondering, so why is a banker on the show that normally talks to entrepreneurs about their exits? Because when you and I met, you started talking about the notion that I'd heard of through the world of this non-equity funding that you've been a pioneer of in New Zealand. And so let's go right back though, because there's some interesting kind of threads that let's set the story up quite nicely. So you began life as a lawyer and ended up where you are. So talk us through a couple of those early motions that will paint the scene as to how you've ended up here.
Sure. So I started my career at a great law firm, Bell Gully, a long time ago, straight out of university. And I loved my time there, but I figured out pretty quickly in the early stages that wasn't going to be me for life. And having travelled a little bit and then come back to New Zealand, as you quite rightly said, I ended up at the Financial Markets Authority at a regulator, and I had a career fork at that stage, and I was looking to do something different from law, and I took the smallest step probably adjacent that you could do, which is go to the regulator, and that turned out to be really interesting. So having gone through the GFC or tail end of the GFC in securities law, and then ending up at the securities and financial markets regulator, I ended up actually doing the the capital raising desk there, and so I worked in this primary markets disclosure team, and the role there was to help companies to explain who they are, what they do, how they make money, what the economic value is that they're creating, and then to describe that in a format that was a new regulatory regime to retail investors. And it just so happened during 2014 that was the best possible time in New Zealand listing history to be doing that role, and we had the luxury or benefit of looking across these really interesting IPOs for the gentailers under one of the old governments, and then a whole range of technology companies, so the likes of Serko, GenTrack, and others all listed during that short window of time, and that was my first real exposure to the tech industry, and And then wanting to go a little bit further, risk on, I ended up at BNZ in banking, and the idea there was to get a little bit closer to, I guess, the action and a little bit closer to an earlier stage of decision making and formation and strategy and the growth of companies. And so I saw BNZ and the finance industry as a way to do that.
So you've been pioneering a product or an offering there, which essentially is quite different to the way that technology businesses go about getting their funding. So first up, tell us how you kind of saw the opportunity in that space and what it is that you do within the bank.
So maybe I'll start with what I do, and then I'll go back to the origins of it. So I head up a portfolio and proposition for the technology industries, and we say technology industries, we think about software enabled, high-tech manufacturing, high-tech infrastructure, and biotech companies. So a broad industry definition of what the technology industries are here. And we started around 11 years ago. I joined BNZ from a background at the Financial Markets Authority regulator, and I think that's really important for two reasons. One, I was outside in and thinking, and I hadn't been a banker or career banker, and so I had no idea what I was doing. And two, I'd had that predilection to the tech industry, of which I was just starting to understand the language and dialogue and metrics around tech companies. And BNZ at that time had a drive to encourage bankers to specialise or focus in industries rather than just be a banker that funds companies between X and Y turnover. Actually think about industry specialisation and the benefits that could create. And you had all this talent and capital and banks that you could apply to certain industries, especially if you got deep or more deep specialist and focused knowledge. And I was the newest banker on the block, and there were 7 more senior bankers in the team, and they chose all the easy industries at the time, and I put my hand up and thought tech would be really easy. And so, cool, I'm going to go and fund tech companies, and that was met with a bit of laughter and a few raised eyebrows, and I hadn't realised how hard that was. I thought, having seen all of those companies lists and the celebrations around all those fantastic companies and the way that they presented themselves in their IPO documents was going to be quite easy to translate to banking, and so.
But it wasn't?
It wasn't.
What was the difficulty?
Yeah, so there's a whole range of things. So banking historically has been structured around tangible things for a start. So if you go right back to the origins of banking, it was related to things that were secured first and physical things like land or bushels of wheat or whatever it may be, and cash flow second. And so that was the start point. And technology companies at that stage, you had some early stage software companies, a lot of perpetual license software models, and some really interesting high-tech manufacturing companies. And they didn't have core value or assets that you could see, feel, and touch, and so, where banking was historically and all the policies and processes and everything was structured around tangible assets, and that understanding and all the organizational understanding was around tangible things. Software and intangible value broke that mold instantly. So sort of step one, and then they looked a bit different from the way that the cash flows, and you're talking banking language. It's based on financial statements, and financial statements were, and the way that they are formed were created a long time before the age of the internet and all these really exciting high tech companies. And so you would get some tech company financials, and you'd put them into the BNZ system, and it was sort of do not compute or oil and water. And
Hey, it's Josh. Thanks for listening to the show. When founders talk about the dream exit, they're really talking about freedom. Freedom to choose how to use their time and to decide what comes next. I'm a client of JB Ware in New Zealand, and I know this is what sets them apart. They help entrepreneurs and leaders turn success into significance. A great exit isn't just about the commas in your bank account. It's about what those commas enable you to create. 2 Commas is proudly partnered with JB Ware, helping founders by putting their wealth to work for generations.
And so, again, being hungry and having put my hand up and said I was going to go fund some tech companies. An opportunity drifted my way by chance for a really interesting company, and we went up against 4 other banks at the time, and we funded them. I didn't know any better. I was desperate to do something and prove that I could fund a tech company, and so we gave $5 million to a $5 million turnover volumes-based platform company that had zero profit, to buy another company that had 5 million turnover and zero profit, so that a combined outcome was 10 million turnover, zero profit, and 5 million of debt, with no personal guarantees, just a general security agreement over the software and the company. And I thought that was normal, and that was approved through BNZ, thankfully. And one thing led to another, and the advisors and investment banker and the accountant and lawyer that were on the company side of that thought that was quite interesting. So, if you can do that, maybe you can do this company, and so that's led to a lot more companies that we've funded over time.
I've mentioned on the show that I have a lot of commercial and industrial property, and over time of the 17 years that I've been accumulating assets in that space, it's gone from having a great relationship with a smart individual banker who gets the business that you go pretty deep with on the finances and the plan and where things could go, and they had quite a lot of authority and the ability to make decisions and make bets essentially on things, and it's all worked out super well. Over time, there's been this drift towards credit. And it's this unseen, faceless kind of group of people that I actually don't know if they really exist or not, or whether it's just a thing that's been put up so that it doesn't come back to your ability to have a good relationship with someone who understands what you're up to. And so the notion of a couple of things there stand out to me. The first is that you're saying that we can get money from the bank without having to put our house up to get that money. So we're essentially funding something that's profitless with the security upon that thing that's profitless, which is remarkable in the world of kind of what you've accustomed to coming from for a lot of folk that are hearing this for the first time. And the second is that you didn't get people further up the chain in credit or otherwise that had like coronaries that you were endeavoring to fund something that was like, this is worthless. Because in traditional parlance, if you looked at that business, it is kind of worthless. We know differently because tech assets are funded in a thoroughly different way. But talk me through those kind of two paradigms that go on there.
Yeah, there's a few things to unpick there. So, and credit, or our credit committees have been a fantastic part of the puzzle and the growth of what we've done, which I'll come back to. So, yeah, I mean, it's a misnomer that we just fund pre-profit companies. I'll frame it up first. So we fund over 1,700 tech companies now from a very low base at the start in a single transaction, and we had enough, or BNZ had enough organisational flex when I first started, and there was a real drive to be the expert business bank for cash flow lending at the time. And I don't underestimate how important that start point was, and our credit team and organisational appetite was on board with that. And it's when I explained the origins of banking being security led and cash flow second, flipping that narrative to cash flow first, security second is a really important start point and dynamic. So it does mean that you can get away with, I don't want to call it an afterthought, but you could downplay the assets that you can't see, feel, and touch piece just slightly, and then you get to the cash flow piece, which again, if there's zero, that's interesting as well. So those are the two dynamics, and I think what we did was I put a lot of effort in, or we put a lot of effort into the early companies, and we formed, which was unusual, the internal paperwork almost like it was an IPO. That's how much effort and diligence went into funding companies, which was, I think, 10 times the amount that you'd normally do for any given transaction. And so we had really good information, albeit it still pointed to the same numbers and security and tangible asset or intangible asset mix. And I think there was a bit of trust in us having done that much work to give a little bit of rope early. And the interesting thing with banking is you tend to fund over 1 or 2 or 3 or 5 years, and so we got through some of those 1 or 2 or 3 or 5 year periods, and things worked out, and so that gave BNZ and myself, frankly, confidence that we were doing something right. And and it also gave our credit committees confidence, and they started to learn more and more around tech companies and how they work, and so we spent a lot of time on that relationship. That was the most important part, and they play a really important function, just to demystify what the credit committees are, to come back to that. So you have your relationship team and frontline banking who go out and see clients face to face and spend all the time and build relationships, and like anything, it's really important to then have a bit more objectivity than the subjectivity that can come with that, and credit committees play a really important function there. But they also have this really wide span where they can see what other bankers are doing and what good looks like and patterns, and so they're a really good soundboard and a pulse on where the market is and what's happening as well, more broadly than the lens that a single banker can have. And actually, they're really amenable, as is the whole bank, to funding, right? Like our business is to be able to fund growth companies, and our whole proposition centered around helping companies as early as possible, funding them as early as possible, and as they grow, we grow, and our economic benefit from those companies grows as their economic benefit from their own activities grow. So it's a really nice relationship from that perspective as well.
Yeah, it's symbiotic. So you've talked about the internal machinations for the bank, but let's double click on what it would take for a founder to have an asset that would look to be attractive for you, and then what process would they have to go through to be able to get access to this type of funding?
Nice. So, well, generally, banking always had lots of C's that you would use, but if you boil it down, there's three key ones in my view. So, character is always a really important piece, which includes capacity, capability, all those things, lots of C words. And then cash flow and collateral, which is that security or what's left over, or what's your asset. And so those things are really important. So understanding who the team is, who the founder is, who the CEO is, who they've surrounded themselves with, is the team of good character and capacity and capability. So that one's what banks have been really good at for a very long time. Cash flow and collateral are two different things. So for cash flow, we're really interested in obviously financial information, but more importantly, and one of the key things I learned, and it was probably a few years in before I really understood the things like unit economics and lead indicators and things that are common vernacular now. We understood them intuitively, but not exactly what they were until someone said, they're just microeconomic measures with different names, and then it's like, oh, okay, cool, well, I can relate to that and work my way back through. But and so we look at lead indicators to cash flow. We're really interested in revenue and size of market and momentum and all those things. And then the asset piece, which you've asked on, is quite interesting. So like asset from a definitional perspective, if you go back to first principles, is and slightly adjacent to accounting, is something, a resource or something that has a future economic benefit. And so we use that concept quite carefully, and it's a really important part of companies coming and talking to us and actually just building their business per se, is what's the recipe or the ingredients that you own and control that's driving the real economic value in the company, and then that's your asset. And then we are not as exposed, if you like, to exactly what that value is. So one of the challenges for tech company valuations or that asset is that the span or breadth of what that could be varies a lot depending on the purchaser or the investor or whoever it is. So if you go to different investor types, the company's worth different amounts, and it's not uniform as with more tangible assets, which have a lot more buyers or depth of buyers at a narrower valuation range. And so that's part of the challenge. But we started with just being comfortable enough that we had our security over the companies that owned or controlled those ingredients or recipe, and that it had some value, and that it was likely to be more than our debt. And that was enough at the start. And then, 10, 11 years in, we've had a lot more transactions eventuate, and we've got a lot better understanding. And actually there's a lot more market data, and there's a lot more transaction examples, which we've always used in other industries. Companies might sell for 2 times EBITDA in various other areas, and in tech, companies, it might be X times recurring revenue, and suddenly now you've got hundreds of examples of what companies have been valued at based on growth rates and revenue levels and all the rest as well. So so that's got a lot easier over time as the market's grown and there's been more examples and more maturity around the tech market. But at the start, it was just there was something. Yep.
Yeah. You were picking up on a number of these points, but individually, you mentioned cash flow and then started talking about leading indicators. That really piques my curiosity and interest because I have a hypothesis based upon too many conversations that I've had with founders, and we operate in similar spaces as we've talked about historically. And I think that, if you want to look at how a company is going to succeed into the future, three critical things are the systems that they have in place to run the business, so making sure that it's repeatable, the clarity of which they're approaching and, dealing with the marketplace in which they're operating. So where are the customers? How are we winning those customers? How much does it cost to get those customers, etc.? And then what are the metrics that we're getting from the business to make sure that we're really clear about our performance across a whole bunch of different fronts? And a lot of people are really good at doing lagging indicators, which is a profit and loss report and a balance sheet. But I don't think many people understand leading indicators. So let's talk about that. What do you go looking for? And what do you think that the average founder doesn't really have enough clarity on inside their business before they come and talk to you?
So I might reframe it as what we see the best founders doing.
Perfect.
So we're looking for clarity. I'll take a step back actually. So banking historically has been based on really lag indicators. So you look at the last 3 years of EBITDA or profit, average that out, and then put a ratio of debt to that. And so even for technology companies, generally the past is definitely not a good indicator of future if you're scaling, because it just changes so quickly. Whereas the mainstay of historical banking might have been more stable companies that were growing at a more incremental level each year. A technology company that's growing 100% year on year is going to look very different in a year's time or 2 years' time than prior. So one of those fundamental shifts was looking forwards, not backwards, for how tech companies were going to work for a start. So and that's still on lag indicators. That's not even getting into the interesting part of that. So, and then you're going, okay, cool. Well, you've got this really ambitious forecast. How's that going to work? And how can you show us some metrics and lead indicators that would give us the confidence that you're going to hit those numbers, because we're believing in your future and funding against that. And so then you start to unpick that, and it's different company by company what those are, and you can get lead indicators and then lead indicators to lead indicators, I think. So so we looked at things like the unit economics and growth rates of companies, and you said customer acquisition cost to lifetime value was one of the early ones that made sense, and if the ratio was okay, then it made sense to keep funding the customer acquisition costs because the economics would work, and your revenue would start to or your gross profit margin would start to outstrip your cost base, and you could see that quite clearly provided the momentum stayed in those numbers. And then it's become more interesting because there's indicators ahead of that. So the reason that you look at the total addressable market and what countries are interesting for companies is in part to prove that you can scale to your forecast, and then you start to look at what's interesting from that perspective. So we look really closely at all the different churn ratios. We're starting to look at usage, daily usage over weekly usage or weekly usage over monthly usage for software as a service platforms as a lead indicator to potential churn, for a lead indicator to potential net revenue retention as a lead indicator for revenue. And you can go on, and depending on the industry, or if it's in consumer land, it might be how much foot traffic, then average basket size, and then conversion, and so on and so forth, which eventually becomes revenue. And so I think because we've been so focused on revenue, and actually we set our rules of our funding against revenue, we've been much more interested versus the average on revenue and lead indicators for funding. And that goes to value as well. There's some other things that can be lead indicators to value, which tend to be growth rates and margin and the unit economics as well, and then they create more value for a potential exit or investor or whatever that may be.
Yeah. So let's talk about the rule of 40. It's been a long time since I've had that conversation on this show. Firstly,
Rule of X now. Yeah.
rule of X.
Yeah.
Okay, cool. Well, let's talk about what the rule is first, and then whether indeed it is important to you.
Yeah, so the very basic definition of rule of X or rule of 40 is making or displaying a ratio between revenue growth or annual recurring revenue growth versus your operating margin or profit margin. And so the idea of that ratio was to show that the expenditure that you were putting into a company was worth the revenue growth in effect, and that would be a lead indicator to eventual operating profits and EBITDA, and so it was a useful way to understand whether a company was overspending for the growth they were getting or not. And we still use it actually. It's a very good catch-all where your lifetime value to customer acquisition cost is just purely on the sales and marketing and travel and all that part of it. The rule of X actually captures that research and development software and product development spend as well. So in combination, they're quite an interesting first ratio, but don't tell all the story always.
I'm going to add some numbers in there because
Sure.
we've been talking about concepts and ideas. And so for those people that are watching and listening to the show, I'm aware that we're quite deep in jargon land. And so what I do for people is I break it down to make it really simple and digestible. And I call it 2020, like 2020 vision is what I explain to founders, especially non-tech founders, but even tech founders who may not have been kind of deep in this space. And obviously you're approaching this through the lens of being a financier with a master's in finance, I think you've got. There's kind of a deep fundamental understanding of these things behind the scenes, and a lot of founders don't have this. So 2020, what I'm talking about is if you can maintain 20% growth and 20% profit inside your business for a period of 3 years, and you can borrow from each of those numbers. So if one goes to 30 and the other one goes to 10, that's okay. The idea is that the aggregate number gets above 40% over that duration. And if you can retain that for 3 or more years, you've got a world-class asset on your hands.
Agree.
Yeah. So you've now called it the rule of X. So does that mean, does it vary depending on the industry? If you're an AI company, it might be rule of 100, for example. But tell me about that.
Yeah, I think it does. And also at different scale points, it's more important or easier to hit a 40% ratio as well. So I think for earlier stage companies that might be sub 10 million of revenue, it's a really hard number to achieve often. And so it's been useful just to track something, and it might be that a rule of 0 is actually quite good, or rule of 10, or whatever it may be, and then other companies have been more ambitious or tried to differentiate themselves from the 40 number and said, hey, 50 is the new benchmark, or whatever it may be. And so I don't have a view particularly on what's right or wrong. It tends to vary based on scale points, and as you say, I think there'll be an evolution of different technology-based companies that are coming out where that might not even be a relevant metric, depending. It's been very oriented towards the current revenue models that we have.
Yeah. And so it's probably an appropriate time to start talking about what's going on a macro basis, and particularly this year. Right now, we're recording this episode late May of 2026. And in March of this year, there was a report written, which was an imaginary company off into some point in the future, and it was the utilization of technology. And what happened in the next 24 hours was what is now called SaaS apocalypse, which was $300 billion was wiped off collective SaaS company valuations. That's now $1 trillion. It's grown from then till now to be $1 trillion. And a lot of that wealth and money has flowed into the AI sector and the Magnificent Seven, which is maybe 10. But how is those events that are going on impacting upon the way that you're now looking at these companies, which for the longest of times, and I remember back in 2019, 2020, I was at SaaSter, the SaaS industry conference in San Francisco. And I mean, you're drinking from not just the Kool-Aid, not drinking the Kool-Aid from the fountain. You're in the fire hydrant there, right? And everyone's frothy as anything about the industry and the multiples and the valuation possibilities, and it's wild. And there was this comment that someone made, which will never leave me. It's that the numbers on a SaaS business, the recurring revenue nature of a SaaS business, is literally bankable. You can take that to the bank. And, it's something that's worth something. And so that's something that's flowed into the conversation that we're having today. But has that changed your view in any way, what's going on in the world right now?
It's a great question. So yes and no. I think one of the really interesting things that's happened with all those headlines is it's created a lot of attention and visibility of what we're doing in the tech industries within BNZ. And there's actually quite a nuanced dialogue and narrative that sits below the SaaS apocalypse or whatever it may be in the headline at the moment as well. So I think firstly, super excited that there's this confluence of other technologies that are coming through and what business models we may be able to adapt to in the future. So, and our portfolio hasn't been all about SaaS. We've funded all sorts of different business models over a very long period of time. And so we've tried our best to keep up with the best companies and what's going on in the market as well. The interesting flow on from the change in the markets from a bank perspective is probably not exactly what you'd expect. So whilst I talked about economic value and one marker for economic value is the listed share price of a range of companies.
A quick one while I've got you. You've probably listened to every business podcast going, this one obviously included. And the biggest calls in your business still feel super hard and are yours to make alone. Talking to founders in exactly the spot, what I've worked out is that more content just won't fix this problem. What you need is frameworks that work in a room of people going through the same journey. That's the Comma Club. There's 50 founding places, and when they're gone, the founding rate goes up with them. Please head to joshcomrie.com to learn more.
The flow on for banking's been interesting because it's meant that companies have been more circumspect around their capital sources and more interested in, and the narrative's really changed from grow at all costs to a lot of more business fundamentals and pathways to profitability and other things that bankers like. And so we've seen a lot more opportunity actually to fund and put debt funding into companies that have been on more of a traditional structure, a debt to EBITDA structure, because they've wanted to, take care of their own destiny and have the control over when and how and what source of capital they might take on to keep growing. So there's that piece there. The other thing, and I'm biased and have to believe this, is that because New Zealand companies that are growing and scaling have both been able to re-platform technologies a couple of times before in their evolution if they've been around for the last 10 years, but they've also been, I think, lesser capitalized or more capital efficient than most of the global listed company base as well. And I have to believe that the AI technology base is a really interesting way to leverage less capital for really niche and interesting companies that are coming out of New Zealand. And I also think there's a really interesting New Zealand play around that regional expertise and deep specialist knowledge in certain verticals as well. And so from a banking perspective, we're really conscious of what's going on globally. We're really interested in how the capital flows are working, because debt can be a complementary source of capital to all forms of equity, listed, private, VC, angel investment, whatever it may be. And so I think we're most wary of how the rest of the capital markets will behave over time, more so than the fundamentals of the companies we're looking at, albeit we're watching carefully, as you'd expect.
What does that mean for someone who's kind of considering what the path forward for them to get through their next round of funding in whatever form that might take? What would be the things that you think they should be kind of present and focused on? So there's probably two parts to that question. So historically, for a lot of people, if they hadn't listened to this conversation, they may not be aware that there is non-equity funding available. So let's tackle that one first. So what would be the benefits of that person considering working with the BNZ? Because I think you're the only trading bank in New Zealand that offers this kind of product or this suite of things in the marketplace, certainly on a basis of having a team and a structure and a support network and behind it. But what would be the thing that you would counsel them to say that this is a strong, viable alternative to you rather than dilution? Is there something that we've missed there?
Yeah, I don't think it's either or as well. So I guess the start point, debt is a form of capital where you borrow from a bank and we take risk and make a risk assessment on the company for a certain period of time in return for interest and fees. And that's all really transparent and clear up front, what that is. And the things we don't do is take ownership or a shareholding stake in a company or board influence or any of those other things that equity may or may not take, or certainly ownership generally. And so I think it's really worthwhile for founders and teams to come and explore what debt might look like and to understand it better. And we're very happy just having a dialogue and explaining the option. And if that's all it is, and the company decides that we're not the right fit and goes down a different pathway, that's totally fine from our perspective as well. And so you can do debt or equity, or you can do debt and equity. And the key things from a founder perspective is just to understand it, make sure that you're aware that it exists, understand how it could fit in, and then understand if it's a good fit for a company, because it can be a great accelerator or it can be not such a good thing to have in a company, especially if your bank doesn't understand what the company's trying to do and how fast that may be. And so I guess the companies that have used this really well have come and talked to us pretty early and thought about how and when debt could fit into their capital mix. They've worked through what constraints that may have. So there's the other thing that comes with debt is generally rules, or they're called covenants, and so we might set some ratios or thresholds that a company has to meet. And it's really important that those don't constrain the strategy and momentum and objectives of a company. So one of the benefits for us is, or using us as well, is we don't require the same level of growth because we've only got a fixed upside interest and fees on the capital as some of the equity investors may require as well. So we can be an interesting source of capital for more moderate growth companies. So I use the tagline that we're very happy if you're growing at 10% or 100%.
Right.
And we can adapt our approach to either of those types of models or anything in between. And so we don't need that growth at all cost to make the economics work from a debt funding perspective as well. So there's a few interesting things in there, but I think the message is really to come and talk to a bank or your bank and just explore and understand what might be available and when and how, and to ask, I think the most important question is, well, what would need to change to unlock X amount of capital from you as a funding source as well, rather than just a binary yes, no.
Yeah.
Because a lot of companies will come and talk one time and they'll get a yes or a no or whatever it may be, and then that's written off that source of capital or all in, depending on what the outcome is for all of their journey as well. And things change really quickly, as you know, in tech companies.
Yeah, absolutely. Yeah, I see that all the time in angel investing. People come and they get an answer on whether their asset is investable, and then they take that story through with them over the life of the conversation. And there's a number of things which could make that inaccurate. They're getting the information from the wrong source. They had an offering or a way of pitching it that wasn't in line with where the market is at. Typically, that'll be pre-product market fit. And so that story will change as they move through different markets, and that journey evolves, and or they misheard something. And there's a whole bunch of other reasons as well.
Sure.
But talking about that angel thing, so you've personally gone in and invested in that space yourself, because there's two kind of they're not diametrically opposed, but they're quite fundamentally different paths to funding that we're talking about today. On the one hand, there is we will provide you with some funding, some resource, and then you'll pay us on an annual basis for the benefit of that resource. And then over time, you'll be paying down some of the principal. I presume it's P&I, kind of in the traditional parlance of debt for property. So you're paying off principal and interest. Is that correct?
So our thesis has generally been you can have the debt on an interest-only basis, provided you're growing well.
Okay, I didn't realize
and that the economics are better for both you and us if you're reinvesting on good unit economics for your growth than they are repaying the bank. And we de-risk our position through your growth rather than through principal repayment.
Right. So that's why you talked about having a long-term relationship, because you're actually not funding for 3 to 5 years. You might be funding until the date of exit. And so that makes it
more... Or forever, ideally.
Or forever,
If it's a growth scaling company that doesn't get to an exit point.
Yes.
As it were.
Yes. So as an angel investor with deep networks in that space, what would you suggest to me that would be something that we're perhaps not seeing or we could be better informed about in relation to the offer that you have at the BNZ?
I think it's really important given the investors' influence and context and potential soundboarding around their teams or board directorships around companies to really understand debt as a source of capital. So there's a lot of assumptions around what we do and how we do it from a funding perspective, and a lot of those, like our principal and interest dialogue just earlier, are not often asked or understood, or it's based on assumptions around the way that they've used a bank in prior companies or different roles. And so my thought would be to come and talk to us and just understand how a debt capital source could really work in with a company either now or later, so that you're well informed and think about it as part of the capital pathway as well. And I guess my sales pitch is also that we don't dilute your shareholding as well. And so if we can help companies through a growth phase that gets the valuation or traction or product market fit further down the path before there's another capital raise, or whether the company needs to raise it all again if they're really going well, it's a really useful thing to understand.
Yeah, got it. I was talking about the fundamental differences between the debt versus the equity. As angel investors, we typically invest with the expectation that our return will come at the point of exit. And you've said that may be an event, but it may also be that the asset continues to run. I say to the clients that I work with, a great asset to buy is a great asset to keep. It's quite different from a great asset to sell as a great asset to keep. So there's a lot of kind of nuances that go around building something of value that's there. So there's kind of two parts to this question. The first is, do you think in New Zealand that we are parting with assets too soon or in the wrong way?
It's really hard to have a view on that. So your expression of it's really interesting. So companies are always, or the best companies are always ready to take on investment, to not take on investment, or if the right buyer comes around at the right time, then that may make sense. And there's certainly cases we've seen where an acquirer has come to a company and offered to buy, and you've got a really interesting thought process then as a team and board around whether that timing is right or whether you keep going. And often it means that acquirer may come in and try and compete with you head on with better resources and all the rest. And so it's very easy to make a judgment outside looking in, but I wouldn't propose to do so from my vantage point. What I would do like to see as a bit of a bias is just that thought around New Zealand nexus and keeping some New Zealand roots to these New Zealand born and bred companies that are succeeding all around the world, and what that looks like, and how do you help the economy get further and further down the path from a New Zealand Inc. perspective as well. And so some of that comes with those, and it depends on the founding team and their personal circumstances and all the rest, whether they want to build something for X amount of time or build something that's a forever and impact type company or whatever it may be. And I think that's really up to those companies and people.
Yes, yeah. It's interesting. There's so many things that one has to factor in when they're considering their exit point in time. The one that's not talked often enough about is that more often than not, when I sit here talking to exited founders, the back end of that journey and then post that exit is an intense period of their life. And often they have faced some form of burnout or they've experienced it, and it happens around about that point in time. Could be a correlation, could be a causation that's going on there. But I don't think for a lot of folk that have the narrative, and you're not one of these, that go, we're selling too many of our assets, they haven't tried to start, grow and run one of these things because they're intense, right? It is I think one of the most fundamentally difficult things you'll undertake in your life is to start and create a successful something from nothing company. And so people underestimate just the personal consequence and toll that it has in terms of their life, your relationships, your health, all those sorts of things. And I talk about that a lot because it's under considered. But for those that have built an asset which is of value that you would look to be an attractive asset, what are the things that those people do super well and that they have their eye on constantly?
Yeah, I think those that build really great companies and assets with great value have a really long-term view on what they're doing. So quite a structured long-term view of what they're trying to achieve, both personally and with the company. The but also the ability to chunk that down into the right here and right now. And that's really hard to do, I think, outside looking in. They have really good people around them. They've attracted really good talent. They have a really good circle of people, advisors, whatever they may call them, surrounding them, both as a human and a business operator. And from a thing that bankers love, they're really good on their metrics and they understand feedback loops and so they've been able to weave a narrative and the storytell around what the company is and where it's going, but couple that really tidily or well with data points and metrics and proof points that show those lead and lag indicators what they've built. And I think the ones that then get even a bit further have thought around how the strategic value of what they've built kind of fits in and some of those things that aren't within the metrics, like network effects and strategic value and maybe market power is the right kind of turn of phrase. And so and they've been thinking about that and growing that and tinkering with that for a very long time, I think. And so it presents as a very cohesive asset and narrative and all the rest that goes with that.
What is the network effect and market power?
So some companies become really valuable. What's the best way to frame that up? So because they've got a client base in an area or a niche that's quite powerful from I guess more of the market they're targeting works with them or is a customer of theirs, and so their business becomes more valuable the more of that customer set or business set that is within that ecosystem and market that surrounds a company, and so they become more valuable the larger they get. Market power is a little bit more nuanced. So where you've got a company that's influential within a market, and so from an asset perspective for someone else to purchase or acquire or look at that company, there's some unique relationships or dynamics that company has that gives you some more power, if you like, or influence within a market.
Yeah, got it. So New Zealand is a small place to do business, famously, and so 1,700 companies. I imagine your network inside technology, we've talked about some of it historically, is phenomenal, and you know a whole lot of people. What do you think it is that New Zealanders could do better around developing their network effect, their market power?
Yeah, I think New Zealand's such a great market for that. So the small degrees of separation mean that you can grow within the New Zealand market really quite quickly once you hit the right threshold. The difference from going from that to doing it overseas is a really different thing. And I think the single thing that I've seen the best companies and founders do is get their key CEO or person up in those local markets to do effectively the same type of thing that they could do back in New Zealand, but with the senior part of their leadership team or the CEO, but also adapt that to the style of those markets. So where New Zealand's quite relational, which I really like from a banker perspective because it's a relationship type game. In offshore markets, we've observed that it's quite different. It's much more cut and thrust and value proposition, and what am I going to get out of this first, and then the relationships sort of the flip side of a meeting.
Yes.
And there's a bit of nice chat at the end of a dialogue, for example, in the States. But the network effects in those markets are a lot harder. So I think, again, if you can understand some lead indicators that you're getting traction and I kind of call it pulling threads, where you're starting to get market pull. I think that companies have done that really well, and increasingly so.
Yeah. I had Lisa King from AF Drinks in the seat a week ago, yet to air, and we were talking about the fundamental differences that she'd experienced of doing business in New Zealand versus in the States. And they have recently hit the press, Walmart and a whole bunch of other, Target, really big retailers, and phenomenal opportunity for massive scale. And so what you've just mentioned there is the difference between my experience is that you have to articulate very, very clearly, and quickly what your value proposition is to someone.
Yes.
So your pitch has to be phenomenal, and I think that's a good thing regardless. Then also you need to know what you're asking of the person and what you can offer for that person in the space of like 60 to 90 seconds, right? You've got to nail that stuff. This is where it gets really interesting. This is where the question comes in. So in New Zealand, we're more like, have a bit of a chat. Who do you know? What are you up to? Where are you going? You know, it's that kind of thing. And so it's a long-winded conversation. We might get to the pitch and the ask at the end of that thing. And so you talked about one of the C's as being character. And if someone was to roll into your office in New Zealand and have the American style or even be an American, we'd kind of go, who is this character? You know, so to speak. And I know that you're inference on the word character was, you mentioned capacity, credibility, and I'd probably throw in capability in there as well to the character thing. So how do you go about assessing someone's character? I want to bring that back into the dialogue.
So I'm pretty open-minded for getting pitched or starting with the relationship chat first, just to clear that one.
Cool.
Yeah, character's really interesting. So it's hard to put a finger on exactly what I mean by that. And I think one of the biggest skill sets you get from being in banking and putting money into people and companies at risk is a bit of what I call a nose for character.
It's like a gut feel.
Metaphorically.
Yeah.
So I think it's one of the biggest skills you can and should develop in banking and finance and investing and all those things. And then there's signals and other things as well. So one of the benefits of banking in the New Zealand market is that the banks have touch points with everybody in New Zealand and very long histories and very long records. And so you can ask probably a few people within the four walls of BNZ and someone will have come across the person that you're talking to. And so you can quickly cross-check that. And I don't think it's very different if you did that outside the bank either, given the degrees of separation in New Zealand. But the other thing that's interesting is that the personality types and ambition levels in tech companies has been really different to what you would have as a relationship dialogue with some of the other companies that I funded in the early days. And so there's an interesting maybe sharpness and ambition level, and those are actually good things, although they might not have been desired traits.
It's not very Kiwi.
From a Kiwi perspective, and so it's just trying to unpick that, and you can assess that again with I think like personalities attract or like characters attract like characters as well, and so we really do look at who is in the company and who they've been able to hire and who's surrounding them at board level, if there's a board, and who's on the investor or cap table and all those other things as well. And then the last part is just the way that they talk and present and articulate their company and what they're up to and who they are. It becomes really important. And so the other clear question is getting an understanding of the person as well as the company and making sure you have those two dialogues rather than just purely the pitch and benefits, in New Zealand culture at least.
Yeah. I spent a number of years in executive search, and so interviewed well over 1,000 people over the duration of that, and consequently became very good at reading and assessing people. It became a bit of a superpower of mine, and it's flowed into this environment, being comfortable asking questions and sitting with the discomfort and knowing how to find a thread and then go for that thing. So like you, having met hundreds, no doubt thousands of founders now, kind of flows into being an innate competence in a way. And so you start to be able to thread together things subconsciously around, does that make sense? Are these things hanging together properly? Is there logic in what they're saying? Has that been validated elsewhere? And it all becomes this kind of, quick thing that happens inside the background there. How do you teach someone else on your team? I don't know whether you've got a methodology for this, but this is the whole, how do you raise competency when you've essentially got founder competency, but in the context in which you're working?
So one of the interesting things we've done is develop a subsector model around tech companies. So we've now got 6 subsectors and leaders that are looking, for example, in fintech or pay tech or climate and clean tech. And a big part of that's to be able to do exactly what you've just framed up, which is to bring others in, have them deeply embedded in markets early before there's a huge opportunity for BNZ from a funding perspective, and get to know all the networks and people within those areas. The same as I've had the benefit of doing in the overall tech industry for a long period of time. And so there's two things there. One, those are really interesting from I guess cutting against the grain of more standardized bank roles, and having people in those subsets for longer and allowing them to grow their careers in a vertical for a longer period of time, and that gets you to the same core understanding of what a good climate and clean tech company looks like, and the founders and the characters and the networks that surround those. And then the other part's actually just trying to understand what it is that you're subconsciously doing around a table. And so again, I've had the benefit of bringing people into the tech market within BNZ and sitting alongside them and providing the feedback loops that they need and coaching, and then you jump in the car afterwards and you compare notes as you do, and you start to teach that, and then they trial and error a little bit, and then they get that skill set as well and develop it. And again, as I said, I think it's such a core competency for bankers to get that nose for character and what you're looking up, and it's interesting. The team all have different traits that they have. Some are more oriented towards the words and numbers that are given, and others are more acutely aware of the body language of people across the table, and all of those things work. They've just developed their own version
Bring them together.
of pattern recognition.
Yeah. You familiar with Moneyball, the book and the movie by
Yes,
Michael Lewis?
Great.
Wonderful movie. The book's a bit heavier to read, but famously he took baseball from being this group of old men that talked about someone having good legs and he's got a great arm and that sort of thing, which was very subjective kind of observation of someone's performance on the field, and especially in trials and the stuff that led to selection. And he brought data to the space, and so very deep analysis, which was very, very objective around a person's performance historically, and then environments and teams and where they might be living and whatever else might be going on in the world for them. What I'm hearing you say is that you have both of those things across the team, and so you kind of try and be as holistic as you possibly can around assessing someone's kind of future likelihood of success, and are they going to do the things that they say they're going to do, and then wrapping that back into that cultural piece, which is interesting, is that Australians, which are two markets that we aspire to get into to succeed in beyond New Zealand. Australia, 6 times the size of New Zealand? What's the States? About 100 times the size of New Zealand, economically, give or take. So obviously they're logical things for us to pursue. Fundamentally, Americans have been trained, encouraged, made okay to embellish. So embellishment is expected. And so for Kiwis, they go into those markets, and this happens in both interview situations and in pitching for business and in offering services to other people, whatever it might be. And they'll overpromise because that's what they expect to do in that seat. And they also know that the buyer will believe half or a third of what they say, whereas in New Zealanders in that kind of environment and situation can cut themselves short, cut their opportunity short, because they'll promise about 80% of what they can do, maybe just a slight bit of embellishment. Have you observed any of these things, by the way? I'm just kind of sharing some ideas and some stuff that I've witnessed over time, and some things that I've seen hold people back in those kind of bigger types of environments.
Yes, so both firsthand alongside companies up there, probably in our own narrative. So we compete in a global banking landscape, and there's opportunities to work with banks globally. And same with equity providers, private equity firms, and others as well. And we've probably heard that narrative more secondhand than being at the front and centre of it. But it tends to always have been the case of, and there's a really nice framing. We had one of our companies present that was in the sales team, and they'd actually set out a bit broader than just Australia and the US, cultural differences, landscape and map across all of Europe and New Zealand, and certainly all the English or more pro-English speaking countries. And it was really interesting just to see, and it was scaled on relationship versus the benefit side, and then also the embellishment level, and it was quite a nice matrix just to frame out how to think about where you should pitch in different markets, and they've been very successful, either consciously or subconsciously, using that kind of thinking
Right.
in a lot of different markets around the world. And so I think that's right. The two things are that embellishment or exaggeration piece, and then the flip of that relationship versus commercial narrative in sessions as well.
Yes. Let's bring this back to banking. So what is it that you wish that more Kiwi founders, company owners knew about kind of banking and the opportunities within it in New Zealand that you don't think that they have enough awareness of?
I think it's getting a lot better. So when we first started in the tech market way back when, there was a pretty interesting reception to a bank turning up at things, more like, what are you doing here, at all of the different industry events we used to go to. And that's really changed. I think the perception around what BNZ and banks have done over the last 10 years, and particularly what we've done in the tech space, has changed a lot. We still, I think, our biggest opportunity is to be better known. So I wouldn't say that we're the best at getting our narrative and what BNZ's doing out into the market, and so there's still a lot of misperception around what banks are and what BNZ's doing, and or there's probably a surface level understanding that we're playing in the tech market, but not actually what it is and how it could benefit a company. And I don't see that as something that's a weakness for founders. It's an opportunity for us to be better and getting our narrative out more, and to get around more founders and explain what we do, rather than the other way around. I've always taken the approach that it's on us as a bank to make ourselves more approachable, understandable, and be out and about and spend the time and earn the trust and deliver a great service and offering to the tech market, rather than the other way around. So I don't have something that I say as a weakness. It's our biggest opportunity is to be better at those things and more approachable.
Yeah, good on you. As much as you can share, what are some interesting developments that we can expect to be coming up in the future from the BNZ and maybe in the sector as well?
Great. So we've launched some really interesting portfolios previously. So whilst we started pretty organically with one transaction or one opportunity and pulled that thread and experimented, we tried all sorts of different things over the last 10 years. Like, I accidentally did a revenue-based finance loan about 9 years ago before I knew what that was, and we funded on a churn ratio maybe 6 years ago before I knew that was interesting. And then over time we've done more and more of similar, I guess, experiments, and had a good feedback loop around those, and shaped those into portfolios, and then presented those out to the market and founders and boards as a more digestible and less bank speak, hopefully. Well, we're trying to do that way of what we do, or presentation of what we do. And so in 2021 we launched revenue-based financing, which was funding against recurring revenue rather than a profit line. And then we developed this project scale-up portfolio, which the genesis or thesis around that is actually which is the same thing we've held true the whole way through, adapt the bank rules to the 15 or 20 highest growth tech companies in the market, rather than shoehorn them into our traditional parameters. And that's called Project Scale Up as a portfolio, which the view there was to develop some future underwriting standards. So work with the best companies, adapt ourselves to them, and then understand what good looks like, both from a funding and a company perspective, and then use those learnings and develop other portfolios for the next generation of companies that are coming through. And so we then developed something called contract receivables financing, which is funding against volume and price and contracts. If you sign up a contract as a hardware or high-tech manufacturer, or whatever your tech business model may be, then we would fund the value of the gross revenues that are in that contract, rather than a profit line, even if it was a few years out. So again, those are all pre-profit mandates, which are quite unusual. And then we're looking at some other opportunities, without naming them specifically, where we can work alongside the venture, family office and private equity community a bit more, and top up some of their funding sources. And we've got a couple of other ideas as some of the AI native business models come through and ways that we might do things. And so I really want to use some of the learnings and experiment cases to evolve those into, I guess, portfolio strategies, and then make those really clear as funding frameworks out to the market, so that it's clear enough where and how and when debt could play a role alongside either your sales, grants, equity capital.
Yeah, got it. Tim, so I'm very grateful for the influence that you've had on the New Zealand technology funding landscape, because it has been quite influential, whether or not you know that. Scattering a few $1 billion around 1,700 companies has moved the needle in a meaningful way. Thank you for going to the New Zealand Herald for your warm-up before our conversation today. So there is another Tim Wixon who lives in another universe, and he's got a deeply satisfying career that isn't the trajectory that you've been on. What is that career?
I think my deeply satisfying career would be back in the Alps, either southern or Swiss Alps somewhere, with much longer hair and a much longer beard, and doing whatever it would take to survive and be a ski bum in those markets until my legs gave out.
I was going to say as a Burmese mountain dog, but no, as a ski bum. Long hair, long beard.
Yeah, I had this great early job as a chalet driver up in Morzine and the Ports de Soleil up in France, and yeah, I think that was a really interesting parallel universe of what life could have been, reading books and skiing all around the Alps. Yeah. Life's definitely about experiences, and so if you can weave those in, whether it's a short or a long-term period of time, I've had such a luxurious life around some of those outdoor pursuits, and so one of the things when you're working in corporate world is making sure that you foster those loves in life as you go along. So whether that's 2 weeks at a time or longer, that's always something that's striving for. Yeah. Tim, what a great conversation. Again, thank you so much for your work and sharing your insight and experience on the show today, and the hope that people can kind of get a sense of what are the mechanisms, what are the worlds they could lean into beyond just kind of the equity path, which has become more and more challenging over the last couple of years as well. So thank you for the work you've done in this space. Thanks so much for having me. Really enjoyed it. Pleasure. Thanks so much for listening to the show. If you've gotten this far, I reckon you've probably enjoyed it. And there's more available for you in the form of my book, 2 Commas. It's available on my website, joshcomrie.com. I've done an Audible version, which is on amazon.com, and there's a Kindle one kicking around on either of those resources as well. I've had some wonderful, unsolicited feedback from early readers. They describe it as being punchy, clear, helpful, and actionable. What it's not is a guide on how to sell your company. You can go to ChatGPT for that. It's more insightful, experiential-based, and a bit of a blend of psychology, philosophy, and what it takes to build something meaningful, and what all that means afterwards. Thanks so much for listening, and I hope you grab yourself a copy.